name is Oystein, Oystein Vaagen. I am the shipping equity analyst at Fearnley Securities, and today I'll have a short presentation walking you through the current shipping outlook and trends that we see in these markets. Just to kick things off, I think the graph on the left-hand side there kind of illustrates, as you can see, at least since 2009, 2021 and 2022 has been the years where you've had the most amount of shipping segments earning above average cash break-even levels for the year, which has meant that in general ship owners have been earning a lot of money recently, which is also has been reflected in ordering for most types of vessels, in particular container and LNG ships the last couple of years, and that has also obviously dictated some, at least to some extent, where these segments are in the different shipping cycles. And the supply side there is obviously very important, and I'll get a bit more into that going later as well. But in general, the tanker, the dry bulk sectors are or do have very supportive supply sides. The order book to fleet ratios are well below the 10-year average levels. And then in LPG, for example, you have a somewhat higher order book. Obviously, at least if you look at the VLGCs, it's very front-loaded. So there will be a lot of deliveries in the coming months, but then after that, it's not that many. LNG, you have a 50% order book roughly. However, it's important to note that in the LNG space, most of these ships are contracted. So there's not much speculative ordering in that segment. And then car carriers or PCC, the order book has picked up quite dramatically over the last couple or over the last year. But, this is a sector that has been underinvested for at least a decade. So you do need a lot of ships to come in there. And then the container space, which is probably the shipping segment at the moment with the least supportive or supply side dynamics, you're also still seeing ordering in that segment. And this picture is, call it, more important now than you historically have seen in shipping because of the yard capacity that you're seeing. If you look at the global shipping fleet at the moment, there is a large renewal need. The global fleet age has gone from 13 years old in roughly 2005, down to around 9 years, and now back to around 13 years. However, because of the large ordering spree that you've seen in container and LNG, at the same time, you've seen yard capacity go down since the 2008 crisis. You basically now have a forward book of 3.5 years on average. So if you want to go out now and order, let's say, for example, a Korean-built LNG ship, you basically have to wait until 2028 to get that delivered. And, new building prices are high as well. Let's not forget that. So if you start to look at this large renewal need, and this also leaves somewhat of a backdrop to why we are generally bullish on most shipping segments, it is that you can see over a 3-year cycle, you need around 10 to 13% order books to maintain the current fleet. Tankers and dry bulk, as I said, well below, but some of these other segments above. But if you take a step back and look at how much tonnage is above 25 years old today, that's roughly 116 gross compensated tons. If you look at global shipyard throughput the last decade, that has averaged around 65 million gross compensated tons. So just renewing what's already above 25 years old will take 1.8 years. So this is why having modern tonnage today is pretty, a pretty good situation to be in. And this is also illustrated here, as you see new building prices on the left-hand side, with steel prices and scrap prices going hand in hand in the middle here. And then obviously when you have that picture and yards have backlogs which are at all-time high levels, they have no incentive of lowering prices. There is a higher willingness to pay for ships on the water today. So with that kind of established and where we are, I think we're going to start to go through these different sectors, which I'll talk, generally about, the commodity-related sectors as well as some of the dry cargo sectors. And starting off with tankers, which is probably one of these sectors, or the sector with the most supportive supply side at the moment. As you can see on the left-hand side, you're going to have negligible, almost, fleet growth the coming years, and that cannot change. That's an important factor because of the supply situation. So if you fast forward into 2027, you'll basically have 5% fleet growth, assuming no scrapping as well. In 2027, 8.2% of the entire fleet will be over 25 years old. So the entire order book today is not even covering renewal. And then you can fast forward into 2030, where roughly 21% of the fleet will be 25 years old. So there is, a lot of renewal which will take place here, and it's almost fair to say that even though if the order book, the order book will go up at some point, but most of that will be used for fleet renewal. And then on the demand side, which tankers, it's important to analyze, and as you all know, it's very volatile. At the moment, you're seeing OPEC cuts, etc. But the underlying trend, trade dislocation and where production is now coming, even though you can start talking about peak oil demand, etc., you are seeing, at least for the next 5 to 10 years, most of new production is coming west of Suez, and all, or pretty much all of demand, as you can see according to the IEA, is coming in the east of Suez. So there is a ton-mile positive driver behind this as well, leaving, the supply side and demand side overall as very bullish going forward. Then over to LNG. This is a market which has probably looks the scariest when you just look at the order book. It's at 50% of the fleet. But as I said, there is roughly, the order book is now at close to 300 ships, and close to 30 of those are uncontracted. So what you can see on the left-hand graph is that there is a lot of FID volumes coming this decade. However, not much is coming before 2026. And as you can see on the graph in the middle, the LNGC market will basically be pretty oversupplied the coming 2 years. But then after that, it's looking pretty good. And if you go into 2028, etc., which we're not showing here, there's still room for more ships. But so if you have uncontracted ships the coming 2 years, there could be a struggle. But if you have modern tonnage, because of the limited availability of modern tonnage, we think rates will hold up pretty well. And also here, if you look at the entire fleet, there's roughly 226 steam turbine ships, which, in today's market where you have high commodity prices as well, the boil-off is becoming pretty expensive, and we believe that a lot of those ships will be phased out once new tonnage hits the water as well. So yes, there will be fleet growth, but the bigger risk in LNG, the ships, they come on time. Shipyards are prioritizing LNG ships because of the margins. The risk is rather that volumes are delayed, which is the big risk always in LNG shipping. But at the moment, it's looking pretty good. Then, the other, call it last commodity segment, which I will touch upon, is also on the LPG side. I will focus mostly on the VLGC, so the very large gas carriers here. And what you are seeing in the market there, and as well as the long-term trends, is everything is pointing towards having pretty healthy LPG trading going forward. You could, it's become a weekly event if you follow the EIA propane inventories in the US. They're rising week by week, as you can see on the top, on the left-hand graph here, which together with a structural decline in US LPG, propane consumption, has meant that there's much more propane available for export. So if you look at US domestic propane consumption, in 2014, the last time you had a oversupply in the VLGC market and the market eventually crashed, 66% was consumed domestically. In 2022, that number was down to 35%, and it's even lower this year. So a lot more is being exported together with more volumes. And then on the other side of the equation, you have rising propane demand from PDH capacity coming largely in China, which is also expected to continue next year. So at the moment, everything is pulling up Far East propane prices, whilst pushing down US Mount Belvieu propane prices. And that increases the arbitrage. And as you can see in the middle here, the arbitrage near perfectly predicts VLGC earnings. So as long as you have those drivers going for you, the market is probably going to be pretty strong. And we expect that to continue at least the coming couple of years. The problem, which everyone was quite bearish, I would say, going into 2023, is the order book. You had a 21% VLGC order book. Obviously, there has been a lot of delays here. So as you can see, the green bars, the real test is still ahead of the market, right? You'll have a lot of vessels coming now until the second quarter of 24, assuming no more slippage, obviously. But we do expect most of that to be absorbed because also at the moment you are heading into the high season in terms of Panama congestion as well. And then post that, the order book is around 10%, similar to dry bulk, split up until 2027. So, after that, it actually has a pretty supportive supply side, leaving us also quite bullish on the VLGC segment at the moment. Then over to call it the more dry cargo related segments, and I'll start off with containers, which is probably the segment which we are the most negative to at the moment from a fundamental perspective. As you can see here, rates, they skyrocketed during COVID. They're now, you could say they have crashed because they are down 90%. But if you look at the graph, I would more say they have normalized. They are back to pre-COVID levels. And if you look at the delivery schedule, thus far this year, you've had 1.7 million TEUs coming, at least last week. And there's still another almost 700,000 TEU to come. So that's almost 10% pre-demolition or pre-scrapping fleet growth. You'll have even more next year, and you'll have some in 25. And what you're seeing at the moment, given these cash-rich owners, the large liners such as MSC, etc., they are still ordering ships, even though you have this outlook, which means that the coming couple of years, combined with what you're seeing on the macro side with high energy prices, interest rates, inflation, etc., that you're going into a long period of a demand deficit here in this space, leaving us quite negative on at least 2024 and 2025. Obviously, there could be some offsetting factors of the fleet, such as slow steaming, etc. But at the moment, this is probably the segment that we like the least out of the ones I'll be talking about today. Then over to dry bulk. If you just look at, I'll focus on the Cape-size ships here, but if you just look at the fundamental data this year, you've had sub 3% fleet growth in the entire space, pretty good demand growth. China has been there as a strong importer of iron ore this year. You would think Cape-size rates would have averaged a lot higher than they have this year. You could basically almost think they would have averaged above $20,000 per day, but it's been closer to 10. The problem has been, as you can see on the right-hand side, is that congestion, or call it a much more efficient fleet, has been in this space. So if you look at the average amount of Cape-size waiting days in ports in China, it's gone from 7 days down now to lows at 2 days. So, but if you take a step back here and you look at the fleet growth situation, as well as dropping iron ore inventories, you have two very fundamentally positive drivers for growth. The problem is that you need something to happen on the inefficiency side. But given waiting days are now at lows, at least low levels compared to where you've previously been, the risk here is now on the upside, we believe. And if you look at basically any shipping market, most bullish markets have come from something which has been unexpected. And the problem, or what you need to have, is that you need to have supportive supply and demand side fundamentals, and then something unexpected can happen. That means, the risk is at the moment on the upside for the Capesize earnings, we believe. And then last but not least is the car carriers, a segment where, ship owners are very happy at the moment. The earnings are at all-time high levels. You have one-year time charter rates at $100,000 plus for the larger ships, whilst if you take what's happened here is obviously you had quite a bit of scrapping during COVID of these ships, and you had on a supply side which has already been underinvested for at least a decade, as I said in the earlier remarks. As well as, you're seeing record Chinese car exports, increasing amount of ships going on the water or seaborne share because of higher margins for the manufacturers. And on top of that, you have the EV space taking shape as well, which have a higher curb weight, which means less available supply of ships at the moment. The thing which is looming over this segment at the moment is the order book, which has grown. If you were to draw a graph of the car carrier order book, it would very much resemble the one I'm showing here in terms of rates. It's picked up dramatically. But we are not that worried in terms of the order book. Firstly, most of these ships are starting to be delivered in the second half of 2024. We are already hearing a lot about slippage in this space as well, as you're seeing across most segments, apart from LNG really. However, as you can see on the graph on the right-hand side, by 2025, for example, will have accumulated around 22% fleet growth. But if you just add, or 30% by 2026, but if you just add a couple of simple factors in terms of increasing ton-mile demand from China versus Japan and Korea, while it's minimal, it has some effect on the fleet growth. And then you add some scrapping, some slippage, that 30% is offset by around 20% of demand growth as well. And then on top of that, you can add slow steaming, which is, for every 1 knot slower the fleet steams, roughly 25 new ships is needed to compensate for that. So we actually think that this order book could easily be absorbed, and we are still pretty bullish on the long-term fundamentals here. So to wrap things up, as I said in the beginning, the shipping sector is definitely aging. There is a fleet renewal need here, and we think if you are a ship owner today with modern tonnage, you should be pretty happy because the interest in those types of ships is pretty steadily increasing. And I think this is just a simple exercise, but it shows quite well our view at the moment, because if you were to buy a 10-year-old ship today, sell it in 15 years, meaning when it's 25 years old, and just use our rate or earnings assumptions for 2025 and keep them flat out throughout that period, you can see it's the commodity-based shipping segments in general, which is generating the highest IRRs in our view at the moment. So with that, I say thank you for your attention.